Here's something we hear constantly is, hey, I hear the Federal Reserve is going to lower interest rates. So that means that my mortgage rate could come down a little bit, right? Absolutely not. That's not how it works. Let's talk about how your mortgage rates are derived and also what the Federal Reserve is and what it means when they're going to lower rates because they are two somewhat connected, but they really aren't. They're two totally different things. Let's talk about the difference a little bit, shall we? So first of all, let's talk about the Federal Reserve. And what that is, the Federal Reserve is simply the central bank of the United States. It's made up of 12 different district banks throughout the country. Each one has a little bit different responsibility, but they really focus on the federally chartered banks in their areas. But they do several things. And there's something called a dual mandate. So when you see Jerome Powell, who's currently in early 2024, the Federal Reserve Chair, when he stands up and gives a speech, when he gets up and talks, what that is, when they're lowering the federal funds rate, that is the rate that banks charge each other or the rate that they go to the Federal Reserve and actually get money for basically short term, almost overnight type of lending. Right now, that runs anywhere from 5.25% to 5.5%, and that's in February, mid to late February of 2024. So when they say they're going to change it and lower it by a quarter point, that's what they're actually lowering. So why do they raise and lower the rates? Well, first of all, what kind of rates does that impact? So if the bank can borrow the money for that, then they turn around and they charge their customers for, say, car loans, equity lines, commercial loans, which are usually short term. And this is a key. This is why most commercial loans don't go beyond 5 years in term. They might amortize, meaning set up the payments for 15, 20 or more years, but they typically balloon, meaning they say you have to pay it all off in 5 years because banks are very sensitive to the ups and downs of these interest rate risks because they borrow short term from the Federal Reserve and from depositors. So the Federal Reserve has what's called a dual mandate. What that means is that they don't just raise and lower the rates. Well, actually, they kind of do raise and lower rates willy-nilly. But what they're supposed to be doing is looking out for two things. Number one, price stability. And that's really inflation. Now, when I was in college 5 years ago, 30 plus years ago, when I was in college all those years ago, I studied under a very pretty well-known economist. And he always used to teach us that 3.1 was pretty normal. Inflation rate, meaning that if a gallon of milk costs $1 today, it's going to cost you $1.03.1 this time next year. So the inflation, prices would go up about that much. And there's a lot of factors that enter into that most people just don't think about. It's almost like you push one lever and then about 20 things happen. For instance, when the Biden administration came in and said, hey, we're going to cancel a lot of the oil drilling and the oil pipelines and all that stuff, gas prices shot up. Well, when gas prices shot up, then the trucking companies had to pay more for gas to be able to ship it, ship goods to your local supermarket. So prices went up. Price of lumber went up. Because it costs money for the chainsaws and for the equipment to be able to go in and get the trees and pull them out and then put them on trucks and ship them, more gas there. So lumber went up. So whenever you push one lever, a lot of other things happen. So one of the things they try to do is to control inflation. So they'll either raise the rates if they want to slow the economy down to try to control inflation, or if they want to stimulate the economy, which is the second thing that they do, maximum sustainable employment, meaning they want to keep the economy in check so that the rates, the inflation doesn't go up too much. But they also want to keep people employed so they can go spend money at the local supermarket, which employs more people, or the car dealership, which employs people in Detroit or wherever they're making the cars. So they want to keep the economy rolling, but at the same time they don't want the prices to go too high. So they kind of have that dual mandate: keep prices under control, but keep people employed, which means stimulate the economy a little bit. So I was taught, back to The Economist in 3.1, I was taught 3.1 was what we're targeting. But whenever you listen to Jerome Powell, the chairman of the Federal Reserve, speak, they're really targeting a 2% inflation rate, which is actually a really low inflation rate. So that's one of the reasons they're keeping rates kind of high right now, is they haven't quite hit, at least in February of 2024, they haven't gotten inflation down under control. As a matter of fact, the last inflation report was actually higher than what they expected, which means I think they're going to kick any interest rate drops that they had anticipated maybe for March or even May. They're kind of going to temper their expectation of lowering rates at that point. So that's kind of what the Federal Reserve is. It is, I hate to say arbitrary, and it kind of is. It's whatever that group of people on the Federal Open Market Committee, including Chairman Powell, what they kind of decide whether they're going to lower or they're going to raise rates. So, but it does not impact your 30-year mortgages. Where does the money come from? It comes from conservative investors, people that are buying bonds typically. So if you're a super conservative investor, maybe an individual with a lot of money that you want to protect, if you're a pension fund that is managing money for a lot of people that are about ready to start getting their pension paid out, you want to protect that money. So you want to be as safe as possible. And there's something called the risk-free rate of return. Well, what is the risk-free rate of return? Well, it's an investment that you can put your money into that doesn't have any risk, primarily U.S. government treasuries and treasury bonds. In order to get liquidity for a lender to be able to go out and say, hey, I'm going to go get the money from Wall Street to be able to lend out to a homeowner that's wanting to buy a house, they have to go out and say, listen, I'm going to give you a little bit more, kind of a risk premium, so to speak, on top of what you could go to the Treasury and buy a 10-year Treasury for. So if you're a conservative investor, and I know darn well I'm going to get my money back by going and buying a Treasury bond, right? A 10-year Treasury. I could do that, and I know I'm going to get, say, 4% or whatever it's running right now. I think it's about 4.2 today. I can do that, or I can I want a little bit extra juice in my investment, but I kind of want to stay conservative. So I'm going to buy what's called a mortgage-backed security, an MBS. CMBS is commercial mortgage-backed security. That means it's backing commercial property. But an MBS, a mortgage-backed security, actually is kind of like a bond that a conservative investor buys. It's going to be priced a little bit above what that risk-free rate of return is. There's kind of a risk premium built in because, hey, I know I'm getting my money back with the Treasury, but, I'm pretty darn sure I'm going to get it back with the mortgage as well. So, hey, it's backed by real estate. It's relatively conservative. So as the as the Treasury rates start to go up, guess what? So do the mortgage rates. When the Treasury rates start to come down, the bond rates, guess what happens? The rates come down a little bit for your mortgages. So that's really what you want to watch. As a matter of fact, if you have an Apple, say an iPhone, and you go over to your stock ticker, T as in Tom, N as in Nancy, X as in X-ray, if you put in TNX and follow that, you're going to be able to see what not the mortgage rates are, but what the Treasury is doing. Treasury goes down, mortgage rates are going to go down. Treasury goes up, mortgage rates are going to go up. And there's different things like employment reports, or unemployment reports, I should say, inflation, all of that do enter into the mix. And the bond prices will go up and down based on that. And then, of course, vicariously so do the mortgage rates. So keep in mind, you're going to want to watch and track that 10-year Treasury if you want to see which direction those rates are actually going to go. So let's take a look and see, are we really in a situation where there's super high rates right now? I'm going to show you a chart, and this is actually put out by the Federal Reserve, the St. Louis office of the Federal Reserve. They put out some fantastic charts, by the way, on the economy long term. But I want you to really take a look. Now, I've added this red line. This was not part of the original chart that was put out by the Federal Reserve. FRED is what it says here, but that's the Federal Reserve chart. But you could go back to 1971 and look at what the average 30-year mortgage rate was during that period of time. Now, you'll notice in 1981, it got over 18.5%. If you're old enough to remember that, and I was still relatively young when that happens, but I do remember that I had a 14% CD in my local bank when I was a kid. That was pretty cool. But the mortgage rates were extraordinarily high as well. It was over 18% to buy at that time. So, rates go up, rates go down. But I want you to look at, say, about the first 30 years of this chart since 1971, 30 years forward. Right now, we're sitting, say, around that 7% mark, maybe a little bit less, 6.5%, 7%. Everybody is screaming at how high the rates are, but historically, it's really not that high. Matter of fact, for the first 30 years of this chart, this would be a phenomenal rate. I'm going to give you a little story. I bought my personal home in April of 2001. So I've been here quite a long time, say 23 years now. And I worked for the bank, so I got these special rates and whatnot. I got lower rates than the customers as part of my perk, so to speak, at the bank. And everybody was marveling at the 7.25% rate that I was able to buy this house that I live in today on. Now, I've obviously since refinanced it and it's way low, but at the time, everybody was marveling that 7.25 was an extraordinarily low rate. And it was at that point. But if you look at historically, we're really not that incredibly high right now. This is kind of normal. What you got used to was a really super hot economy. Treasury rates were extraordinarily low, just ridiculously low. They had jacked down the interest rates. The Federal Reserve had jacked down interest rates. The Treasury rates were extraordinarily low, and that's why you were seeing mortgage rates that actually there was. I think it was in January, late January of 2021, the rates got down as low as 2.71% on a national average. Some people are even have mortgage rates today from that period of time that are actually lower than that, which is blowing my mind, right? So a lot of people have sub 3% rates right now, and that's one of the reasons you're not seeing a lot of inventory hitting the market right now is because people have those extraordinarily low rates. And gee, I'd like to trade up a little bit, but when I think about it, my rate's going to go from 3% up to 6.5, 7%. I just can't afford as much house as what I would like to be able to. So I'm just going to stay put and put money, into a new pool in the backyard or something like that. That's actually what my wife and I did. We decided, she talked about, she builds houses. She's fantastic at it. She was going to build us our dream home. And as we looked at, financially, did it make sense for us to do? We're like, gee, we have this extraordinarily low rate. We don't owe a lot on the house. So why don't we just stay here and put a lot of money in the backyard, put a pool in, nice area, and we can enjoy it. That's what people are doing right now. And so you're not seeing a lot of new houses hit the market because people are just staying in place. They've got extraordinarily low rates. Why would they move? It's crazy. So anyway, this chart, I think, is fantastic to be able to illustrate that we're really not in an environment where the rates are kind of out of control, so to speak. Would be nice if they came down a little bit, maybe into the mid fives or whatever. But honestly, when it got so extraordinarily low just a short time ago, down into, the sub 4 range, honestly, that's almost too low for a healthy real estate market. So hate to break it to you, but that's really not healthy. Anyway, let's talk about treasury rates over the last year and kind of where we're at. People are saying, oh my God, rates are going to come down, rates are going to come down, but are they really? We did get, as I mentioned a little bit earlier, some disappointing news as far as the inflation rates. They're still much higher than what the Federal Reserve would like to see. When the inflation rate came in 0.2% above what they expected recently, well, the treasury markets reacted negatively to that and they kind of popped up a little bit. So that's why you're seeing the rates kind of staying high. People really don't believe that the economy is getting as good as what they're hearing from government officials. And keep in mind, an election's coming up. So they're going to spin this in a very positive light. So, oh, the rates are coming down, rates are coming down. Are they really? We don't know. So we want to really keep a good eye on it. I do think they're going to come down a little bit later in 2024, but it's not going to be just this big time drop like some people are saying. So let's take a look at this chart. This is just actually, I snapped this from my iPhone. I did this on the 18th of February, and it shows what where the treasury rates were at over the last 12 months. So after the last year. And you could see they kind of took a big dip a little over a year ago. They got down really low and everybody was all excited that the rates were coming down. Rates are coming down. But look what they did steadily into the fall, into October, which I know everything bad seems to happen in the stock market in October, right? The Great Depression started in late October. All these bad things happen in October. But it did go up. And then all of a sudden it started to come down. Hey, great, it's coming down again. Fantastic. But watch what it did relatively recently. It's been creeping up a little bit, and a lot of that has been because a lot of the expectations that the government has said, hey, rates are coming down, unemployment's getting better, inflation's getting better, everything's wonderful. You're hearing that in the media. Markets reacted to the positive news by having it coming down a little bit. And then when they found out that that really wasn't true and they had to restate some of these figures, pop back up again. So let's just keep a very close eye on that TNX, which is the 10-year treasury. That's really where your mortgage rates are going to derive from. So if you start to see that go up, rates are going up. If you start to see those things happen where they're coming down, rates are going to come down. That's how we predict rates and decide, kind of help our clients decide when to lock a rate in. So anyway, I hope that was very helpful. Simple, it's not. I've studied this my entire career. Studied economics very closely. Worked in banks as a bank executive for many, many, many years, over 30 years, as a matter of fact. So I kind of have a leg up on understanding when these things happen and when they don't. But hopefully that's a little snippet into how interest rates are derived, what the difference between the Federal Reserve rates, the federal funds rate that they arbitrarily change, and what the mortgage rates actually are that they go off of the treasuries. And I hope that really helps you to be able to determine when to buy a home, when to refinance, and just at least understand the process a little bit better. Until next time, we'll talk to you soon.